Welcome back to Crypto, one token at a time. The podcast where we don't just name drop coins, we tell their story. Every episode, we explore one project from the top of the crypto charts, breaking it down in plain language. What it is, how it works, where it came from, and where it could be going. Today, we're diving into something that almost every crypto user has touched, but few have truly understood. This one's not about volatility or innovation or speculation. It's about stability. Let's talk about Tether, better known as USDT, the world's most used stablecoin. Let's start here. What is Tether? You've seen the ticker. You've probably used it to trade or move money between exchanges. It feels invisible. But Tether is anything but. In a world of volatile coins and chaotic markets, Tether offers something rare in crypto, a fixed price. 1 USDT equals $1. Simple on the surface, but beneath that simplicity lies one of the most controversial, important, and systemically critical projects in the entire crypto ecosystem. Because while Bitcoin is about scarcity and Ethereum is about programmability, Tether is about stability and liquidity, and it might just be the glue that holds the crypto markets together. So, where did it come from? Let's rewind to 2014. Back then, Bitcoin was still in its early days. Trading was chaotic. There were no real stablecoins. If you wanted to exit a trade, you had to convert back into fiat, which meant bank delays, fees, and regulation headaches. A group of entrepreneurs like Brock Pierce, Reeve Collins, and Craig Sellers saw this problem. What if there was a digital dollar you could use inside the crypto ecosystem? Something you could send like Bitcoin, but that didn't bounce in price every day? They launched a project called RealCoin, which later rebranded to Tether. Their goal was simple: tokenize the dollar. Back every USDT with a real-world USD reserve, and let people move dollars at blockchain speed. So how does it work? At its core, Tether is a centralized stablecoin. That means it's issued by a company, Tether Limited, which claims to hold assets equivalent to the number of USDT in circulation. You send dollars to Tether Limited, they mint an equivalent amount of USDT. You can now use that USDT across crypto platforms. If you want to redeem your USDT, you send it back to Tether. They destroy the tokens and send you dollars back. USDT runs on multiple blockchains: Ethereum, Tron, Solana, Polygon. It's portable, liquid, and fast. But unlike decentralized protocols, Tether relies on trust. Trust that the reserves are real, trust that they'll honor redemptions, and trust that the system won't break under pressure. What does this enable? Tether makes crypto tradable at scale. Without it, exchanges would constantly struggle to manage fiat pairs. USDT acts like a lubricant for liquidity, smoothing out trades, arbitrage, and settlements across markets. It's also used for remittances, cross-border transfers, and even bypass of banking restrictions in countries with unstable currencies. For example, in Argentina, Lebanon, Nigeria, people use USDT to preserve value when their local money collapses. It's not just a tool for traders, it's a lifeline for millions. Let's talk tokenomics. USDT doesn't operate like Bitcoin or Ethereum. There's no mining, no hard cap, no staking. The supply grows or shrinks on demand when users deposit or redeem real dollars with Tether Limited. The key metric isn't the tokenomics, it's the reserves. For years, critics slammed Tether for not being transparent about what backed USDT. Was it really dollars or commercial paper? Loans? Crypto? After regulatory pressure, Tether began publishing regular attestation reports. Snapshots of their reserves, now reviewed by third-party accounting firms. Today, most of Tether's reserves are said to be in U.S. Treasury bills, short-term, low-risk government debt. That shift towards safer assets has helped rebuild some trust. Adoption? It's massive. As of 2025, USDT has a market cap over $110 billion, making it the third largest crypto asset in existence, right after Bitcoin and Ethereum. It dominates trading volume. On some days, over 70% of all crypto transactions involve Tether. Exchanges, DeFi protocols, OTC desks, remittance platforms, everyone uses it. You can find it on Ethereum, on Tron, on Solana, and it continues to expand into new chains and L2s. But there are challenges. Let's be honest, trust remains the elephant in the room. Tether Limited is a centralized entity based in the British Virgin Islands. It's faced lawsuits, fines, and constant skepticism from regulators and media. In 2021, it paid an $18.5 million settlement with the New York Attorney General for misleading claims about its reserves. While Tether has improved transparency since, it still refuses full audits, a major point of criticism. Then there's competition. USDC issued by Circle is gaining traction, especially with institutional partners. And decentralized stablecoins like DAI or CRVUSD are trying to offer the same stability without needing a company at the center. Finally, there's the regulatory risk. If governments crack down hard on stablecoins or demand banking-style compliance, Tether could face existential pressure. So what's new with Tether? In 2024 and 2025, Tether made some bold moves. It launched Tether Gold XAUT, a gold-backed stablecoin. It started investing in Bitcoin mining operations in South America, and it expanded into AI infrastructure, saying it wants to diversify beyond finance. These aren't just financial moves, they're geopolitical plays. Tether sees itself as a global financial infrastructure layer, especially in regions where the dollar is strong, but access to it is limited. What's next? Tether's future depends on two things: trust and resilience. If it continues to back USDT with safe, transparent reserves and keeps regulators at bay, it could remain the dominant stablecoin for years. But cracks in confidence, or a major loss of reserves, could trigger a systemic shock. By 2030, we might see a stablecoin world split in two. Regulated, transparent coins like USDC dominating in the West, and high-speed liquidity-first coins like USDT leading in emerging markets. Or maybe if it evolves enough, Tether could be both. One last story to close. There's a wild stat that still stuns people. Tether's trading volume regularly exceeds that of Bitcoin and Ethereum combined. Not because people are investing in it, but because they trust it enough to use it, again and again, to move billions every single day. In crypto, trust is currency, and for now, Tether is still spending it. Thanks for listening to Crypto One Token at a Time. If you learned something today about the strange, powerful, and sometimes risky world of Tether, share this episode with someone who thinks stablecoin just means boring. Next time, we'll explore another project shaping the future of Web3. And remember, Bitcoin is for holding value. Ethereum is for building value. Tether, it's for moving value. See you next time.